In today's video, I'm going to show you how to build a powerful, high-probability trading strategy using just two simple indicators. And not just that, I'll also show you how to automate the entire system in just 5 minutes. If you want to trade like professional traders instead of randomly buying and selling, then this video is for you. By the end of this video, you'll know how to build a strategy, how to test whether it actually works, and how to fully automate it without writing complex code. But before we jump into strategy creation, we first need to understand 3 important concepts that every profitable trader must know. 1. Expectancy. 2. Risk and reward. 3. Maximum drawdown. Expectancy tells us whether a trading strategy can make money consistently over time. It's not about winning every trade. It's about whether your average profits are bigger than your average losses. Even a strategy with just 40% win rate can still be profitable if the reward is much bigger than the risk. Risk and reward means how much you are risking to make a certain amount of profit. For example, if you risk $100 to make $300, your risk-reward ratio is 1:3. Professional traders focus heavily on this because strong risk-reward can make a strategy profitable even with lower win rates. Maximum drawdown is one of the most important metrics in trading. It tells us how much your strategy can lose during bad market conditions. For example, if your capital falls from $100,000 to $80,000, your drawdown is 20%. A strategy may look profitable, but if the drawdown is too high, most traders won't survive emotionally. But here's something very important. No single strategy works in every market condition. Sometimes trend following works, sometimes breakout strategies perform better, and sometimes momentum completely disappears. That's why professional traders never depend on only one strategy. Instead, they build multiple strategies with different logic and parameters. For example, one strategy for trends, one for pullbacks, one for breakouts, one for momentum, and one for reversals. So if one strategy goes into drawdown, another strategy can still generate profits. This is called diversification in algorithmic trading, and this is what helps traders build more stable long-term systems instead of depending on one single setup. In this strategy, we use multi-timeframe confirmation to filter weak trades. Instead of taking random entries, we first identify the overall market direction using the higher time frame, and then we use the lower time frame for precise execution. This helps us get better entries, smaller risk, and higher probability setups. Before taking any trade, the market trend must be bullish on the 2-hour time frame. In this strategy, we use an RSI length of 5, and signals are confirmed only when the RSI remains above 45. If RSI stays above 45, it means buyers are still active and bullish momentum is strong. This condition helps us avoid weak and sideways market conditions. But remember, we are not taking entries on the 2-hour time frame. We only use it to confirm the overall trend direction. Once the higher time frame trend is confirmed, we move to the 15-minute chart for execution. Here, we use Supertrend with settings 10 and 5, along with RSI using length 3. When Supertrend turns green and price moves above it, it signals short-term bullish momentum. But instead of chasing the move immediately, we wait for a temporary pullback. When RSI drops below 10, it shows aggressive short-term selling pressure. But we still don't enter there. We wait for momentum to recover back above 30. That recovery tells us buyers may be stepping back into the market. So now we have higher time frame bullish confirmation, Supertrend supporting momentum, and a recovery after the pullback. And together, that creates a high probability long setup. For exits, we let momentum decide. When RSI reaches above 95, the market enters an extremely overextended condition. At that stage, probability of reversal increases sharply, so we secure profits and exit the position. And for risk management, Our stop loss is fixed at 1.5%, while the target is set at 3%. This gives us a clean 1:2 risk-to-reward ratio. That means even if some trades fail, a few strong winners can still keep the strategy profitable over time. And one more important thing. Professional traders never jump directly into live trading. They follow 3 important steps: backtest, paper trade, live trade. First, they backtest the strategy on historical market data. Then they test it in paper trading. And only after consistent results, they move to live trading. Now let me show you how to automate this entire strategy in under 5 minutes using AlgoXera, an AI-powered algo trading platform. AlgoXera comes with an AI wizard where you can simply explain your strategy idea in plain language, and the AI automatically helps convert it into a complete trading strategy. And the best part is, we've already added this strategy inside the Ideas section, so you don't need to build everything from scratch. You can directly copy it into your workspace. In backtesting, you can analyze everything. How many trades were profitable? Your overall win rate, profit factor, average profit per trade expectancy, and maximum drawdown. Once the backtest looks good, you can deploy the strategy to paper trading. And once you're satisfied with the results, you can automate it for live algo trading in less than 1 minute. And just like that, we successfully built a complete trading strategy and automated it within minutes. If you enjoyed this video, make sure to like, subscribe, and hit the notification bell, because I'll be sharing more powerful trading strategies, automation tutorials, and AI trading systems very soon.